Welcome back to the deep dive. Today, I want to try a little experiment with you. If I ask you to picture the future of finance, and I
Mm,
mean the real bleeding edge where all the rules are being rewritten from scratch, where does your mind go?
It's a reflex, isn't it? You
Yeah.
immediately picture, I don't know, a sleek glass office in London, or maybe a coffee shop in Palo Alto.
Exactly. Guys in hoodies coding the next big thing.
Right.
It's the standard mental map we all have,
Yeah,
Silicon Valley, New York, maybe Singapore. But today, we're basically tearing up that map.
we are.
We're looking at a stack of research that suggests we've all been looking in completely the wrong direction. We're diving into something called the Lagos Protocol,
And, this isn't just about a different place on the map. It's about a completely different logic. While the West has been sort of tweaking existing systems,
making an interface a little prettier.
exactly, or a transaction a millisecond faster,
Hmm.
Nigeria has been quietly building something fundamentally new from the ground up.
It's framed as the fintech future, but, not in the way we usually hear that phrase. We are not talking about slow, incremental change here.
No.
We're talking about a timeline that feels, well, it feels almost impossible. A zero to billions explosion in just 5 years.
To really get your head around the scale of this, we have
Mhm.
to start with the event that put it on everyone's radar. The industry actually calls it the Flutterwave Signal.
That sounds dramatic, like a flare going up in the night.
In financial terms, it was exactly that. Flutterwave is a Nigerian fintech company. And when they had their exit event, their big valuation,
Right.
it wasn't just a good day for one startup.
Okay.
It was what they're calling Africa's rarest fintech exit. It was a signal to the entire global market that this was no longer a side project. This was a unicorn factory.
Okay, but let's unpack that for a second, because we hear about unicorns in the US all the time, right? A software company goes viral, gets $1 billion valuation. It's almost normal. Why is this specific signal so different?
It's all about the environment it grew out of. That's the key. I mean, if you build a billion-dollar company in San Francisco, you got cheap capital, stable infrastructure, a banking system that's been there for a century.
Right. All the rails are already in place.
Exactly. Flutterwave and this whole ecosystem built that kind of value in an environment that traditional finance had, for all intents and purposes, abandoned.
And that really brings us to the core mission for this deep dive. We have to figure out how. How do you go from absolutely nothing to billions when the cards are so stacked against you? The research keeps using this phrase, mobile-first sovereignty.
hmm
And I want to dig into that because sovereignty is a heavy word. It implies power, not just tech.
It is about power.
Yeah.
It's about who owns the rails that money moves on. But before we get to the sovereignty part, we have to look at what's called the mobile paradox. This is really the engine that started the whole car.
Right, I was looking at the data on this, and it really doesn't seem to add up at first. It feels contradictory.
It's a classic economic mismatch. Let's just look at the two numbers that basically define modern Nigeria. Number one, you have 75% smartphone penetration.
That's massive. That's 3 out of every 4 people walking around with a supercomputer in their pocket. They're on social media. They're consuming data.
Totally. High digital sophistication.
Yeah.
But then you look at number two. Roughly 40% of the entire population is unbanked.
Okay, I have to stop you there because this is where I get stuck. If
Yeah.
I have a smartphone and I have data, why can't I just, download a banking app and open an account? Here, if you have a phone, you have a bank. What was the actual barrier?
It's a great question, and it's the absolute crux of the problem. In the traditional banking model, the
Yeah.
one that was imported from the West, you need a very specific kind of identity to have an account. And that identity is physical.
Physical.
You need a utility bill with your name on it. You need a formal street address. You need a credit history.
Ah, I see. And in a massive, often informal economy like you'd find in Lagos,
You might live in a place that doesn't have a formal deed. You might pay your bills in cash to a landlord. You just don't have that paper trail. So you walk into a legacy bank, and they basically look at you and say, you don't exist.
so you have a phone, a business, you have money, but to the bank, you're invisible.
That is the paradox. You're digitally visible, but financially invisible.
Wow.
And this huge gap created a kind of pressure cooker. You had millions of people who were tech savvy, but completely locked out. That vacuum is where mobile-first sovereignty was born. It wasn't about building a slightly better banking app for people who already had accounts.
Right.
It was about realizing that the phone itself could be the bank.
So the phone isn't just a remote control for your money anymore. It actually becomes your identity.
Precisely. The innovators in this space, and this is where we get into the real strategy, they realize that your digital footprint could be a proxy for that missing utility bill.
How so?
Your GPS history, your airtime top-up patterns, your messaging data, all of that paints a pretty clear picture of who you are, how stable you are.
So they just replaced the physical paper trail with a digital data trail.
And that just unlocked the floodgates. But that's only the user side of it. That gets people into the system. The much bigger challenge, and this is where companies like Paystack and Flutterwave really earned that zero to billions name, was the plumbing.
The plumbing.
Yep, the infrastructure. Because, it's one thing to hold money on your phone. It's another thing entirely to move it efficiently. And this brings us to what the research calls their killer app, cracking remittances.
I feel like remittances is one of those dry financial terms that just glosses over how unbelievably difficult the actual process is. When we say they cracked it, what was so broken?
Everything was broken. I mean, everything. Let's say you're a Nigerian designer with a client in London, or you have family in Houston trying to send money home. 5 years ago, that money had to go on this nightmare journey through intermediaries.
Okay.
Goes from a U.S. bank to a correspondent bank in New York, maybe then to a clearinghouse in Europe, then to a major African bank, and finally maybe to a local branch.
And every single hand that touches it takes a fee.
A huge fee and time. We're talking days for it to settle. And the exchange rate you get. It's terrible. You're getting gouged at every single stop. It was slow, it was expensive, and it was a friction that just strangled commerce.
So how did Paystack and Flutterwave actually fix that? I mean, did they just build a faster Western Union?
No, they did something much more fundamental. They rebuilt the architecture. They built what's called a middleware layer. Imagine a kind of universal translator for money.
A universal translator.
Yeah. On one side, you've got Visa, MasterCard, global banks, all speaking their own complex language. On the other side, you have all these fragmented local African banks and mobile money wallets speaking a totally different technical language.
And these fintechs sit in the middle of all that.
They sit right in the middle with a single API and application programming interface. It lets a merchant in Lagos just put a tiny snippet of code on their website, and then suddenly a customer in California can pay $50 on their Visa card. The API catches it, instantly handles all the compliance, the exchange rate, all the logic in the background, and settles it right into the merchant's local Naira account.
So they just flatten the entire stack.
Completely. They made the borders invisible.
Yeah.
That's cross-border dominance.
Yeah.
They didn't just bank the unbanked. They connected the local economy to the global economy.
Yeah.
And that is why the valuation exploded. They became the gateway.
Okay, so here's where it gets really interesting to me. Usually when we talk about this kind of rapid fintech explosion, it comes with a side of chaos.
Oh, yeah.
You know, that Wild West vibe, crypto scams, rug pulls, startups just ignoring laws until they get big enough to hire lawyers. The Silicon Valley mantra is literally move fast and break things.
Right. Disrupt first, ask for forgiveness later.
Exactly. But looking at the Lagos protocol, the trajectory seems, I don't know, surprisingly disciplined. The research calls it regulatory evolution, which, frankly, sounds almost boringly responsible.
It does, doesn't it? But here's the twist. In this specific context, compliance wasn't a hurdle they had to overcome. It was a competitive advantage. It was a survival strategy.
I'm a little skeptical. Usually compliance is just corporate speak for we have good lawyers. Are you saying they actually wanted more regulation?
Think about the environment again. In a high-trust society, maybe like, say, Sweden, you just assume a new app won't steal your money.
Sure.
In a low-trust environment, where people have been burned by failed banks and countless scams, trust is the single scarcest resource. If you move fast and break things in Lagos, you don't just get a fine. You get zero customers. No one will ever trust you with their savings.
So by building compliance directly into their DNA from day one, they were actually buying trust.
That's it. They worked with the Central Bank of Nigeria. They literally helped write the new rules. Remember the identity problem we talked about?
Yeah.
The lack of utility bills? These companies helped pioneer something called tiered KYC, know your customer. They went to the regulators and said, okay, if a user only gives us a phone number, let's give them a tier 1 account with a low transaction limit.
I see.
If they add a bank verification number, we bump them to tier 2, higher limits. If they provide full documentation, tier 3, no limits.
That's brilliant. Instead of a simple yes or no for access, it's a ladder. You build trust over time.
It's a ladder. It perfectly balances risk with access. And because they built this with the regulators, instead of fighting them, they guaranteed their own survival. They weren't trying to dodge the government. They were trying to build infrastructure the government would one day rely on. That's regulatory evolution.
It makes so much sense. If you want to become the sovereign rail for a whole nation's economy, you can't be an outlaw.
You can't. And that compliance FOIA model is now becoming the export.
Which leads us perfectly into the next wave. Because this isn't just a Nigerian story anymore, is it? The Lagos Protocol is spreading.
It is. The blueprint has been proven to work. You're seeing the exact same pattern, mobile-first, API-driven, compliance-heavy-taking route now in Kenya, in Ghana, in South Africa.
It's becoming the Pan-African standard.
It is. But this is where we need to look to the future. We've covered the last 5 years, this incredible explosion, but the research projects all the way out to 2028 and introduces a concept that I think is the most provocative part of this whole story, the sovereign corridor.
The sovereign corridor. It sounds like something out of a geopolitical thriller. What does it actually mean for how money moves?
It means Africa to world financial rails. And the directionality of that phrase is critical. Historically, the financial relationship has always been world to Africa.
Right.
It's aid flowing in or Western banks extracting value out. The infrastructure, the actual pipes, were owned and controlled by London, New York, or Paris.
So you're saying if I wanted to send money from, say, Nigeria to Kenya, historically that transaction might have actually routed through New York first?
Often, yes. It would go out to correspondent banks in the West, accrue all these fees, before ever coming back to the continent. It's absurdly inefficient. The sovereign corridor is about building direct rails, a system where African fintechs own the infrastructure that connects them directly to the global market, completely bypassing the old gatekeepers.
That's a massive shift in the power dynamics. You're talking about cutting out the middleman, but in this case, the middleman is the entire traditional global banking system.
Exactly. By 2028, the projection is that these rails will be so robust that an African business won't need a Western intermediary to trade globally. They'll have their own sovereign pipe to the world.
So what does this all mean then? If we zoom out, we have the Flutterwave signal that woke everyone up. We have this paradox of high-tech and low banking that created a vacuum. We have these companies that filled that vacuum not just with a cool app, but by solving the really hard plumbing problems and doing it with strict compliance. And now they're building this sovereign corridor.
It's a complete re-architecture. And it brings us right back to the premise we started with, while Silicon Valley sleeps.
Right. That's the question that's just been hanging over this whole conversation.
If Nigeria has managed to go from zero to billions in just 5 years and is on track to establish this independent corridor by 2028, what does that mean for the traditional financial hubs?
Are they even paying attention?
Well, some are, for sure. But many are still operating on the old assumption that they are the center of the financial universe. They assume that eventually these African markets will just plug into their systems.
But the Lagos Protocol suggests the exact opposite.
The complete opposite. Nigeria isn't building a plug for Wall Street. They're building their own power grid.
And if that grid becomes more efficient, faster, cheaper, and more inclusive than the legacy systems,
then the center of gravity begins to shift. We could wake up in 2030 and realize that the most advanced payment infrastructure on the planet isn't in London, it's in Lagos. And the traditional banks will be the ones scrambling to figure out how to be compatible with it, not the other way around.
that is a staggering thought to end on. The idea that while we were all watching the usual suspects, the real revolution was happening in a place we weren't even looking.
It's the classic innovator's dilemma, isn't it? You ignore the underserved market until it becomes the market that eats your lunch.
Well, on that note, we are going to wrap up this deep dive. It's been a fascinating look at how necessity really is the mother of innovation and how quickly the global map can be redrawn.
Absolutely. The future is being built.
Yeah.
Just, make sure you're looking in the right place.
Thanks for listening. We'll catch you on the next deep dive. Stay curious.